Welcome back to Roxham TV. I'm your host, Jenny. If you are just joining us, today's show is packed and is moving fast. We are starting with a major market story that's hitting tech stocks globally. Nearly $1 trillion has been wiped out from software companies in what people are now calling Software-mageddon. Investors are suddenly questioning whether AI is still helping software businesses or replacing them. We'll break down what triggered the sell-off, why this matters for SaaS, and what the market is really pricing in. Then we'll zoom out to the global picture. Japan's election just sent shockwaves through markets. Japanese stocks hit record highs. The yen, the bond yields moved. Bitcoin and gold both jumped at the same time. We'll walk through why Japan matters so much for global liquidity and what to watch next across the market. Then later in the show, we have a special guest that you have been asking for, who is Jayant Ramanand. The co-founder of Mantra will join us today live. You all remember what happened back in 2025 when the OM token crashed nearly 99% in a single day. So today we're asking the hard questions. What really happened? What lessons were learned? And what comes next? I'll be raising the critical questions you have in mind, like no fluff, no dodging. So stay with us, hit the like button to support the channel, and we'll get started with the market. So first thing first, Software-mageddon. Let's start with what happened in the tech market. So this is actually not a normal tech sell-off. Over the past week, software stocks around the world have been crushed. And the reason is simple. Investors are suddenly afraid that AI is not helping software companies anymore. It's starting to replace them. So since late January, the software sector has lost between $830 billion to $1 trillion in market value. This is one of the worst collapses since 2022 tech crash. So if we take a look at the S&P Software and Services Index, you will see, okay, if we scroll down, it's already down 17% this year. I mean, year to date, that means till February, so 2 months. So this 2 months is down 17% and nearly 30% below its October highs. This sell-off event has a name right now, and people are calling it software. Wait, let me scroll up. So Software-mageddon. So for the past 2 years, AI was seen as a growth story for software companies. So that means more tools, more subscription, more revenue. That is in the ideal world, but that story apparently just flipped. Now investors are asking a very scary question. What if AI does the job of the software company itself, not helping humans use tools, but replacing the tools entirely? The sell-off really picks up around February, so just a few days ago, February 3rd or 4th. And the trigger was quite quiet but very powerful. The reason why everyone is panicked in the market is because like this guy. So Anthropic released 11 open source plugins for its AI agent, so Claude. So there's no flashy event, no big keynote, but the market noticed immediately. Like why this is a really good tool. We covered that on Roxham TV before, but this is a powerful yet very scary tool and is threatening software businesses. So here's what it looks like. So if you go to Claude Co-work, you can create a new task to start a new activity. So what you could do is basically you could do legal review, you could do sales workflows, marketing tasks, finance analysis, and data queries, like all in one system alone. There are no separate apps, no human handoffs, just AI agents doing the job end to end. And this is the key fear in the market right now. AI is moving into what investors call the application layer. This is where most like software as a service, so SaaS companies like Microsoft, make them money. Traditional SaaS works like this. So they have one tool and they have one task and one subscription. But agentic AI works very differently. Like one AI agent, it can read the emails, it can analyze documents, it can update CRM systems automatically, and it can prepare reports or talk to customers, all without needing 5 different tools, 5 different software products. That means lower pricing power. That means fewer subscriptions and less recurring revenue. And investors definitely hate that uncertainty. So now let's hop onto the stocks market. So tech stocks, how they are doing right now. So of course, like legal and data companies were slammed. Enterprise software names follow. So if we take a closer look to Microsoft, past month performance is down 16%. Like that is a lot for a multi-trillion worth of companies, and it's down 16%. And cloud funds dropped sharply as well. So another one we could take a look at is First Trust Cloud Computing. The ETF is down around 15% in the past month. So it's down sharply. Like even companies that are labeled as AI leaders were not spared, because the fear is not about who builds AI, it's about who gets replaced by it. And this sell-off went global. European software firms dropped hard. Asian tech and IT services firms sold off. Indian IT exporters were hit especially badly. This is simply because low-cost human labor models are now being questioned. If AI is cheaper than outsourcing, the whole model would change. So, like, do we still need that freelancer from India right now in this stage of the market? So this panic did not happen in isolation. It was amplified by higher interest rates, by tighter budgets, and slower global growth. When companies feel pressure, they cut software fast. Like they will cut that with no doubt in mind. And if AI can do more for less, CFOs will move very fast, and that's why markets are pricing in right now. Of course, some analysts will say like this is just short term. They argue AI tools are still heavily subsidized. They're not really enterprise ready, and security and reliability are not solved. So some stocks may bounce, but this is important. Like the long-term fear is very much still real, because the tech development today is not just better chatbots. AI is now planning tasks, is executing workflows, and coordinating multiple agents working with a massive data set. This is what people call the agentic AI era, and it is moving much faster than expected. That puts pressure on junior roles, especially, or on freelancers, or maybe routine white collar jobs. And the markets are forward looking. They don't wait for layoffs to happen. Big tech is spending hundreds of billions on AI infrastructure. That money is making AI tools cheaper, faster, more powerful. At the same time, companies are under pressure to cut costs. So that combination creates a perfect storm that we are seeing today, right now, especially in the tech market, in the tech companies, that is being fully reflected in the S&P Software and Services Index. So the clean takeaway is that this sell-off was not about earnings. It was not about guidance. It was just about fear of disruption, which could be very valid. AI is no longer just a feature. It's becoming the product itself. Some software companies will adapt, some will shrink, some may disappear. Short-term rebounds are possible, but the message from the market is loud and clear. The software business model is being rewritten, and AI is holding the pen. So, of course, we'll keep watching this sector very, very closely, and how Microsoft is going to bounce from here. Next, we also have a big global market story that is moving Asia, the US, and crypto all at the same time. So Japan just held a major election, and the outcome is already sending shockwaves through markets. So Japan's Prime Minister, Takuchi, she has just secured a huge election victory. Her party, the Liberal Democratic Party, won a 2/3 supermajority in Japan's lower house. That is a very big deal. That means she now has strong political control and the freedom to push through her economics plans without much resistance. Markets, of course, reacted immediately. So today, like on Monday, the Japanese stocks surged to a new all-time high. So if we hop onto the Nikkei index, so Nikkei right now is sitting, okay, it broke 57,000 for the first time ever. This is a historic level that we've never seen before. The broad topics index also hit a record. This move is being called the Takachi trade. Investors are betting that her policies will boost growth, increase spending and keep money flowing into Japanese assets. So now let's talk about the yen as well, because like people like to do the carry trade. So Japanese yen strengthened after the election, moving to around 156. So it's going down a little bit. That means it's getting stronger for the Japanese yen. But here's a twist. For herself, so let's go back to the picture. So Takaichi is known for supporting looser monetary policy and high government spending. Over time, that can actually place pressure on the Japanese yen to go lower again because she wants the Japanese yen to be not so strong. So currency traders are watching this very, very closely. At the same time, if we hop onto the Japanese government bonds, bond yields are moving higher. So the 10-year rose to around 2.27%. While the 20-year right now is sitting at 3.17%. So rising yields it actually signaled the markets to expect more government spending, more stimulus, and possibly more inflation down the road. This rally also quickly spread across different markets, so it's not just Japan. So if we look at other Asian markets, so South Korea's market jumped more than 4%. Australia market moved up as well. So as Hong Kong. So Hong Kong Hang Seng Index moved up 1.72%. So this was a regional risk-on move, especially across Asia. Now, if we bring this to the US futures moved higher as Asia rallied. Last Friday, US stocks had a huge rebound. The Dow Jones closed about 50,000 for the very first time. This is a psychological milestone, of course, like the number 50,000. And the S&P 500 jumped nearly 2%. The Nasdaq climbed more than 2%. Tech stocks led this bounce after heavy selling earlier in this week. Even with Friday's rally, here's the context you need to know. Big tech has lost more than $1 trillion in value over the past week, like we covered that in a previous story. So this bounce matters, of course. Investors are rotating, not panicking. So what this showcases is that money is very much still in the system. They're just moving around. As one strategist put it, like this is an AI gold rush. But the money carousel scares people sometimes. So how about we bring that to Bitcoin? Let's take a look at the crypto market, Bitcoin market. So Bitcoin surged alongside global markets as we had a really painful weekend. Of course, I was away. That's why I wasn't doing live shows. But we know, we dropped below 60,000 briefly. Right now, we are sitting at 70K. So let's do a little bit of chart analysis because it has been a very, very scary time. So let's start with the 2 weeks for now. So 2 week, and then we're going to hop on to weekly, and then we're going to do the daily as well. So not going to lie, I predicted the bear market quite perfectly well. So I've been talking about the 4-year cycle, while a lot of people have been mocking me, making fun of me. But yeah, I mean, at the end of the day, profits matter more than how people think of you. So for the 2 weeks, okay, I've got the Gaussian channel. Let's close it for now. So one thing about 2 week that is very concerning is that if we bring up the 50 SMA, so 50 SMA is sitting at 88, or around 87.5K, somewhere around that. So last 2 week candle, this is very concerning because we closed below the blue line. So we close at 76K, somewhere around that. So this is going to be a huge resistance, especially across 88K. And not going to lie, okay, how rapid we crash over the weekend was very, very surprising as well. However, that being said, I do not think we have seen the cycle bottom just yet. So in other words, there will be more pain. So the level of 59K or 60K depends on which exchange you use. So 60K, let's call it 60K because it's a round number. So 60K, I do not think is going to be a cycle bottom. I think there is more room for correction. The reason why I would say this, because cycle bottom doesn't develop this fast. So this is just within 3 weeks, and then we dropped from, how much is that? So we dropped from 93K, that is back in 19th of January. So if we take the bottom, so 60K, that is a 36% drop in a matter of 3 weeks. So this cannot be a cycle bottom because how rapid it dropped. And other reason is that according to the 4-year cycle, so if we hop onto the weekly right now, and if we close the moving average, so according to the 4-year cycle, the cycle bottom will not happen until October of 2026, so October this year. So in other words, if we apply that, that just means there will be more pain ahead of us. So the cycle bottom will be on 5th of October 2026, and there's still months to come. So another question people like to ask, okay, if this is not the cycle bottom, if there's more room for correction, first of all, we're gonna take our time to get down to whatever price will be. And then second question people like to ask is, okay, how low will we go if this is not the cycle bottom? So one thing I spotted weeks ago, days ago. Well, I forgot, because I've been on holiday. So one thing we spotted very perfectly well is this bear flag pattern that's been playing out. So if we basically just use the top to the breakout point, where is it? So this is not the perfect chart. It's not the perfect pattern I could draw. So if we take the bear flag that we spotted back in November 2025, and if we just take the top to the support level, and if we go to the breakout point, there'll be around 55K, or if we go down here, it's going to be 54K. So 54K is another level I'm eyeing very closely. And other immediate basically, what we're trying to say. So immediate price action is the 74K. This is a level that I call out because 74K, it happened to be the previous all-time high back in March 2024. And the fact that we break 74K as well, that means, okay, there'll be more room ahead of us, more room to the downside. And right now, 54K is going to be, this is a level I'm eyeing very, very closely. And as I was sharing throughout my live stream, I've been talking about the buy order I set around 70 something K. There's one buy order, it trigger at 77K, and then another one trigger at 63K. But like I've got what according to the site to the TA, I'm going to put a bunch of buy order at 54K as well. So this is the I'm going to slowly DCA in the market, though I do not think this is going to be the cycle bottom. And according to the bear flag, 54K looks justifiable. Like it's not going to be very easily supported around that. But like if we have a slow grind towards the 5th of October 2026, maybe we're gonna drop a little bit further, but we will take it from 54K. So in other words, 54K, I got a bunch of buy orders. So let's also hop on to the daily. So daily is more like for the immediate price action. Of course, like weekly, I'm still DCAing a little bit. But for the daily, I like to have a quick flip. So I like to trade the market a little bit. Like for those of you who doesn't, who think trading is a little bit stressful, I get that. Then just do DCA and just like buy when it's like ultimately very, very cheap. And especially we drop towards the, on the weekly candle, we drop towards the 50 SMA. So that is like a fair value to ape in a little bit. But for trading wise, one thing I find it very interesting, and this is the indicator that I've been using very much lately, and so far it's been working very well in my favor. How do you read this though? This is basically the 1-day cycle time frame. So how this works is just like a bunch of waves. So it's a little bit similar to RSI, but like this is a little bit easier to read and to turn a quick flip using the 1-day cycle indicator. So whenever we get to like the top, so around 80, that means okay, Bitcoin might be at the top right now. It's getting a little bit overvalued. It's a good time to take a little bit profit. And so vice versa, if we go to 20, that is a good level to maybe aim a little bit, like short-term wise, because right now we focus on the daily candle. So bear that in mind. So if we do just a quick back test, all right. So here we have the cycle indicator call out the top perfectly, and here as well. So caught the top on 16th of January. So we could do like this back test over and over again, but like point being, this is a really good indicator that I've been using, and I've been flipping using that for trading quite profitably well. All right, so according to the 1-day cycle indicator, we are getting towards the top as well. So I've talked about shorting the market throughout September 2025, and I'll talk about taking profit for months. And people call me crazy, especially institutions and TradFi, but that's fine. And right now, since we are getting towards the top of the daily cycle time frame, of course, like we could trade the wave a little bit. You could pull in a few shorts. I do not recommend pulling shorts for Bitcoin because like maybe I'm getting sentimental for Bitcoin, and Bitcoin is like right now sitting at fair value 69K. That was the previous all-time high. So very likely want to like hover around a little bit. Maybe we crash down a little bit according to the daily cycle time frame, but like shorting altcoins, it makes sense. But shorting altcoins is a little bit difficult because like sometimes, especially a lot of altcoins, a lot of meme coins, they are controlled by market maker, so they could squeeze you out if there's like a big short position that they see, because that is the advantage of market maker. They always front run you. So that is something we need to bear in mind if we're shorting the market. But I'm using it for risk management. So I'm not being like a degen and I'm not pulling any leverage. Like it's not healthy to use leverage at the moment being, especially seeing, okay, in the past 24 hours, we look at the rack number, there'll be $364 million got racked. And it's very, because since I'm tracking this liquidation heat map every single day, like it's very common to see a number above $1 billion. So point being, try to stay away from leverage. And if you do want to do a quick flip for shorting the market right now, just focus on the coins, maybe mid cap or slightly bigger altcoins, because like for an altcoin that's too small and for some reason still being accepted on centralized exchanges, like market maker can really easily squeeze you out if they see there's like your positions is really big. Like if it's just like $1,000, then maybe it's fine. But like if somewhere like above like 10K, then that is a concern that we have. So if you have a slightly bigger short position for altcoins, just try to focus on maybe large cap altcoins or mid cap altcoins. Definitely try to stay within the top 100 crypto. So that is the trading strategy that I have. Like, okay, as I mentioned, I do think according to the 4-year cycle, there's a slow bleed towards 5th of October 2026 this year. And so that's for Bitcoin. Let's also hop onto gold right now. Because because of the Japan's election, not just Bitcoin is jumping up, gold is jumping up as well. So gold surge. Right now, we are sitting at $5,000 per ounce. So we are seeing something quite rare. Risk assets like stocks are going up, and safe havens like gold are also going up. That tells us one thing, like markets are positioning for big change, not calm stability. This rally also comes as a global politics shift. The US and India just released a new trade framework. President Trump also removed a 25% tariff on India, linked to the India market buying Russian oil. That improved global trade sentiment. Donald Trump also publicly congratulated Prime Minister in Japan winning the election, calling her a strong and respected leader. Political alignment matters for the markets right now very much, but it's very rare that when it goes down, especially past week, gold goes down, stock goes down, and Bitcoin goes down. So this is a phenomenon that we haven't seen in the market. Okay, key takeaway for this news. Japan just gave its strongest mandate in years to a leader who supports growth, spending, and loose policy. So I'm going to pay very close attention on those Japanese yen. Markets, of course, love clarity now that we know who's in charge. Stocks surged, the yen moved, bond yields rose, and this is not just a Japan story. This is a global liquidity story, and it tells us risk appetite is actually still alive, but volatility is not going away. So try to stay away from leverage, as I mentioned. Keep a close eyes on the yen, on the US stocks, and also in Bitcoin, because when Japan moves like this, the rest of the world would follow as well. All right, so we'll take a short break for now. And when we come back, we are diving into the world of Elon Musk, because he just shifted his focus in a space plan. Right now, we're focusing on Moon instead of Mars. So do you stick with us, and there will be more juicy news coming back to you.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
So, tell us about your furry friend here. What's his name?
Oh, this? This is Bitcoin.
Bitcoin?
It's not just a cat, he's family.
Quite a name, and I must say, looks quite pampered.
Oh, absolutely. Bitcoin deserves nothing but the best. He's my little prince.
But with such a valuable pet, aren't you afraid of losing him?
Losing Bitcoin? No, it never happened before, so it's not something I worry about. Excuse me for a moment. Bitcoin, stay here, right?
Bitcoin, no! Bitcoin, come on, little buddy, Bitcoin, I need you. Don't go.
In a world far away. Nah, just kidding. This story begins in this world. It all started in 1460 in Antwerp, when the first commodities exchange was created, but the real transformation came in 1602, when the Amsterdam Stock Exchange was founded. Considered the oldest in the world, it was the first to trade financial assets. Over the years, Britain expanded its colonial and maritime influence, and the British pound sterling overtook the Dutch guilder in the market. Thus, the London Stock Exchange became the financial centre of the world. The 20th century came, and the world got into some trouble. But shortly after World War II, the Bretton Woods Agreement established the dollar as the world's primary reserve currency, and the centre of the planet moved to Wall Street. Today, we're travelling at the speed of light towards a new age, an era shaped by the consolidation of Bitcoin as the currency that will define the future of the markets. We present Roxum, a new Bitcoin-denominated market that allows trading all sorts of securities, commodities, derivatives, options, and anything you can imagine. Roxum, rock-solid markets.
Some call me Chicken Little, others Bubble Boy. I'm a bit changed, but sounds familiar, right? Let me tell you a hard truth. The S&P isn't rising, the dollar's falling. That's the trick, monopoly money. It's ice melting by the second. Your savings, your salary, your time. Worth less every second. Everyone's using the wrong measuring stick. Switch the denominator. Price the S&P into Bitcoin. Hard, fixed, unprintable. Suddenly your unstoppable index, it's collapsing. And while you cling to dollars, well, Wall Street already switched. Before, you needed 2 brokers.
Still getting my ninja bonus though, right?
Plenty of spreadsheets. And my quant!
I hate this part.
I was right, and I'll be right again. If I were you, I'd thank me.
You know my name's Dave, right?
Welcome back, everyone, and thanks for sticking with us. So there's a big change in Elon Musk's long-term vision. For years, it was all about Mars. Right now, Elon Musk says the moon comes first. And it's not just a visit, he's talking about building a self-growing city on the moon. So let's break it down, what's happening step by step. So what Elon Musk just said is that he said this can be achieved in less than 10 years, and he is right now prioritizing a permanent city on the moon. Mars is still part of the plan, but it comes later. According to Elon Musk, building a city on Mars will take much longer. His reasoning is actually very practical. So flights to the moon are much easier. There are huge difference. So a moon mission can launch every 10 days. Takes about 2 days to arrive. While as for a Mars mission, it can only launch once every 26 months, and it takes about 6 months to get there. That gaps matters quite a lot. What this means is that there will be more testing, more learning, more iteration. If something breaks, you don't have to wait 2 years to try again. You can just try next week, and that is a massive improvement. That is a massive advantage. As for Mars, Elon Musk says Mars is not cancelled. He still believes uncrewed mission can begin in about 5 to 7 years. A long-term Mars settlement is still the end goal. But Mars is much harder, like more distant, of course, more risk involved, a lot more expensive. The moon is a faster, fast step. Elon Musk uses the phrase self-growing city. What that means is that it means a settlement that can expand on its own, not just astronauts visiting, but like permanent habitats, manufacturing, energy systems, infrastructure, a city that needs less and less support from Earth over time. In simple terms, the start of an off-Earth civilization. That's what he's trying to build on Moon right now. Many space analysts say this pivot from Elon Musk is actually very logical and it makes a lot of sense. It's also a perfect testing ground for life support systems, construction, and energy. Everything needed for Mars can be tested on Moon first. And there's also another layer here. Global competition in space is rising. The Moon is now a strategic focus for major world powers. Returning humans to the moon has become a national priority again. So by focusing on the moon, SpaceX aligns closely with the current policy goals. This shift also connects with Elon Musk's other projects. So he has space infrastructure, AI, and space-based computing. All of these benefit more from orbital systems, lunar development, near-Earth operations. So a Mars colony doesn't help much in the short term, but the moon does. That's why they pivot. The big question now is execution. So do you watch for the new infrastructure contracts, early habitat prototypes? So talk right now is one thing, hardware is another, of course. So markets and governments will be watching this very, very closely. All right, moving on to the next story. Like this is a big one. This time, the Epstein file, actually, the revelation is a lot bigger than a lot of us expected. So new Epstein documents have been released. There are millions of pages, thousands of videos and images, and the fallout is no longer just legal or social. It's very much political and even financial. So let's break it down. Jeffrey Epstein's just a quick context. So he was a U.S. financier and of course, a convicted sex offender. He died back in 2019 while awaiting trial on federal sex trafficking charges. For years, his case has raised one big question, like who else knew and who else was involved? Epstein built relationships with very powerful people. So I'm talking about politicians, business leaders, royals, academics. Being named, however, does not mean guilt, but association does matter, especially in politics. So what was just reviewed? On basically 13th of January, the DOJ released the largest batch ever. We are talking about over 3 million pages, more than 2,000 videos, and hundreds of thousands of images. And that files will include emails, flight logs, financial records, and even unverified hotline tips. So here's where it gets interesting. The political fallout has been much bigger and much stronger in Europe than the United States. In Europe, association alone can end careers. There's a stronger culture of accountability. So as a result, we are seeing basically a mass flow of resignations, investigation, and public apologies, all happening very fast. So in Britain, so here we have the Britain Prime Minister, the impact is very severe. The Prime Minister, Keir Starmer, is right now under real pressure. His closest aide resigned after backlash over an appointment linked to Epstein associations. That resignation exposed fractures inside the government and markets notice. Political instability spilled into finance. The British pound weakened, government bond yields rose. Investors began pricing in political risk. So traders right now is asking questions. So will leadership change? Will policy shift? And will stability hold? When confidence cracks, markets react fast. And this story shows something deeper, like markets don't wait for outcomes. They price uncertainty. If investors see leadership risk, they demand higher returns. Simple as that. However, this is not being played fairly compared to like between Europe and US. In the US, the fallout has been very much muted because like at this point, no one really cares anymore. Many names were already known. Politics is deeply polarized in the US, so scandals don't move the needle the same way in Europe. Europe does. There are also heavy redactions in the files, so which critics say protect certain names, certain interests. So far, no major resignations is going on in the US, no immediate political collapse, but like public frustration is definitely growing. So let's be clear here. These files contain allegations, mentions, associations, but they do not prove guilt just yet. Investigations are ongoing. Some cases may go somewhere, some cases may not go to anywhere, like others may reopen. This is about transparency, but not verdicts at the moment. So here's what matters going forward. Just what we have to watch is watch for whether like more resignations would happen in Europe, if criminal reviews turn into formal charges. There are no more large file dumps expected, but investigations are not over. So of course, we'll be watching this very closely on Roxham TV. So let's move on to some Bitcoin news for now, because this is one of the craziest exchange mistakes crypto has ever seen. Like it happened in South Korea. So Bithumb, of course, being a very popular exchange in South Korea. So what happened is that there was one internal mistake, and suddenly hundreds of users were giving thousands of BTC each. So let's break it down. Last Friday on 6th of February, Bithumb was running a routine promotion as always. So the goal was simple: reward selected users with 2,000 Korean won. That's about $1.40. So a very tiny bonus, nothing special. But what actually happened a few days ago? So instead of 2,000 won, the system credited 2,000 BTC per user. So it's not a joke, not a hack. It's just an internal input error. In total, about 695 users were affected. Around 620,000 BTC were sent out by mistake. At BTC price around like $70,000, that's roughly $44 billion. Once users realized what happened, of course, things escalated fast, like people move fast. Some users that received the Bitcoin immediately sold parts of the BTC. That caused a flash crash on Bithumb. Bitcoin's price on the exchange briefly dropped to up to 17%. Within 35 minutes, Bithumb froze trading and withdrawals for the affected accounts. Surprisingly, almost like Bithumb was not affected by this and almost got all the Bitcoin back. Bithumb said it recovered 99.7% of the Bitcoin. Of course, not all of them. About 0.3% is still missing. That's roughly 1,860 BTC. At the current price, that will mean $130 to $115 million gone. So response from Bithumb, that was not a hack. What they're saying is that there was no security breach, no system hack, no outsider attacker. It was just a pure internal mistake. Like in other words, fat finger error. This actually exposed a very serious system weakness. Large transfers like this should really require multiple approvals, hard limits, and automatic alerts. For example, like if the payout is 1,000 times bigger than normal, basically just stop the transaction. But that did not happen here. Detection took 35 minutes, which is an eternity time in crypto. South Korea's Financial Services Commission has launched an investigation, not just into Bitcoin, but into all other exchanges as well. This incident raised alarms in a country where crypto adoption is already extremely high, so expect tighter oversight after this. This incident briefly shocked the wider crypto market. It added volatility on top of already nervous conditions. And here's the uncomfortable truth. This is actually not new. It's not like news in crypto. Crypto history is full of similar mistakes. So wrong refunds, wrong transfers, or glitches during promotion. Sometimes funds are recovered, sometimes there will be lawsuit follow. The common thread is simple. So centralized platform hold massive amounts of money and humans still control the system. So this, of course, bring us back to the old lesson, like not your key, not your coins. Exchanges are, of course, very convenient. They offer liquidity. They make trading a lot easier, but they carry significant amount of risk. So operational risk, human error risk, or custody risk, even without hacks. So for long-term holdings, it's always a good idea to have cold storage when you control your keys, like exchanges errors don't affect you and system freezes don't trap you. So for active traders, a hybrid approach actually makes sense. So using multiple different exchanges, because if one halted withdrawal, you always have another one for backup. So I have like 3 exchanges on hand, like trade on exchanges, but like store the bulk amount of your assets offline. Personally, I use Tangent the most. So this is the cold storage option, is my go-to option because it's very easy to carry around. You don't have to charge this. This is just the size of my credit card. So I carry this around. And right now they have a new feature called Tangent Pay. This is a cold storage. But since they are offering the Tangent Pay feature, I'm testing that out as well. So you could just like tap this card onto any Visa terminal. So you could just pay in USDC. So I've been using this Tangent card for years. If you want discount, I got like a promotion code for 10% off. So just type GEM10. So anyways, going back to this news, the clean takeaway here, this is not a hack. Like this was worse in many different ways. A simple human error almost moved $44 billion. Bitcoin recovered most of it, but the incident exposed how fragile centralized systems can be. In crypto, the biggest risk are not always hackers. Sometimes it's just like one wrong input. And here's a reminder no investor should ignore. Like, we'll keep tracking this news here on Roxanne TV very closely. So for now, let's take a short break, and when we come back, we have the co-founder of Mantra Chain joining us, so do stick with us.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
So, tell us about your furry friend here. What's his name?
Oh, this? This is Bitcoin.
Bitcoin.
It's not just a cat, he's family.
Quite a name, and I must say, looks quite pampered.
Oh, absolutely. Bitcoin deserves nothing but the best. He's my little prince.
But with such a valuable pet, aren't you afraid of losing him?
Losing Bitcoin? No, it never happened before, so it's not something I worry about. Excuse me for a moment. Bitcoin, stay here, right?
Bitcoin, no! Bitcoin, come on, little buddy. Bitcoin, I need you. Don't go.
In a world far away. Nah, just kidding. This story begins in this world. It all started in 1460 in Antwerp, when the first commodities exchange was created, but the real transformation came in 1602, when the Amsterdam Stock Exchange was founded. Considered the oldest in the world, it was the first to trade financial assets. Over the years, Britain expanded its colonial and maritime influence, and the British pound sterling overtook the Dutch guilder in the market. Thus, the London Stock Exchange became the financial centre of the world. The 20th century came, and the world got into some trouble. But shortly after World War II, the Bretton Woods Agreement established the dollar as the world's primary reserve currency, and the centre of the planet moved to Wall Street. Today, we're travelling at the speed of light towards a new age, an era shaped by the consolidation of Bitcoin as the currency that will define the future of the markets. We present Roxum, a new Bitcoin-denominated market that allows trading all sorts of securities, commodities, derivatives, options, and anything you can imagine. Roxum, rock-solid markets.
Some call me Chicken Little, others Bubble Boy. I'm a bit changed, but sounds familiar, right? Let me tell you a hard truth. The S&P isn't rising, the dollar's falling. That's the trick, monopoly money. It's ice melting by the second. Your savings, your salary, your time. Worth less every second. Everyone's using the wrong measuring stick. Switch the denominator. Price the S&P into Bitcoin. Hard, fixed, unprintable. Suddenly your unstoppable index, it's collapsing. And while you cling to dollars, well, Wall Street already switched. Before, you needed 2 brokers.
Still getting my ninja bonus though, right?
Plenty of spreadsheets. And my quant!
I hate this part.
I was right, and I'll be right again. If I were you, I'd thank me.
You know my name's Dave, right?
All right, welcome back to Roxham TV. Right now, we are shifting from the market headlines to a much deeper conversation about building in crypto during such volatile time. Over the past few years, this industry has moved really fast. So bull markets, bear markets, and moments that really test founders and teams. So joining us today, I have a special guest, is Jayant Ramanand, the co-founder of Mantra. So Jayant has built across traditional finance and Web3, and today we'll talk about his journey and how he thinks about the market in times like this, what it actually takes to keep building when conditions are tough. So Jayant, welcome to the show.
Thanks so much for having me. It's a pleasure to be here today.
Yes, it's a pleasure to have you. So since this is your first time here on Roxham TV, why don't we start with a quick intro? So your background before crypto, how did you get into crypto?
Okay, sure. Before getting into crypto, I was living in India working for S&P, which is the global credit rating agency in India, working on their credit risk products and implementing it for banks in India, the Middle East, and East Africa. While doing a lot of this, I also realized that all of the ratings that are happening and all of the things that are working out over there are all moving towards a form of digitization. And at that point in time, blockchains and crypto weren't really a thing. They were just coming about in terms of concept into the mainstream. In India, I think like the Bitcoin caught on a little bit later, at least for the audiences that I was working with at the time. And once I found out about Bitcoin, then I read more about blockchains, and that began my entrepreneurial journey where I built my first startup in India, trying to organize urban mobility and then having blockchains as a means to essentially record all those transactions. One of the things that I realized was that blockchains and developing crypto products in general is fairly capital intensive, and it also requires people that have a bent of mind for innovation. A lot of that may not have been quite developed in 2016 back in India, which is when I moved to Hong Kong. And once I moved to Hong Kong, I was part of Hex Trust, which was a crypto custodian, working with bringing institutions into the wallet environment of Bitcoin and the likes of other crypto assets as well. And then following that, since 2020, I have been with Mantra and then started as a DAO, which has then evolved over the last 5.5 years into becoming its own blockchain, specifically designed for tokenization, because that is where it is bridging the old world of traditional finance and the new world of crypto and blockchain finance that we're doing. So this is like the healthy meeting ground of the two ideological clashes, and that's what I've been building towards for, the past decade. And now I am here sitting next to you.
Yes, I mean, that is a very interesting journey. So you mentioned that you built a startup back in India and then you moved to Hong Kong and you joined Trucks. So I wonder, what is the culture or crypto scene, the biggest difference you notice, like in the Indian market? How is the crypto adoption going on compared to Hong Kong? Like, what is the major difference that you learn from these two different markets in both India and Hong Kong?
That's a great question, because I think if you look at just the sheer numbers, India is always amongst the top countries in terms of crypto adoption around the world. That's primarily because of the sheer volume of people that are coming on chain or creating wallets in a day-by-day basis. But if you look at it, you have like maybe a couple of 100 million people in India that are using blockchains at all. But if you compare that to the population of India, it's still a very small amount of penetration in terms of like the general understanding and the knowledge needed to operate within this environment. So I think there's a lot of Indian FUD, for want of a better word, when we talk about crypto in general, we talk about blockchain. There's a lot of institutions that understand the value of technology or distributed ledgers, but then there's still the type of people that say blockchain and not crypto. So there's still a lot of the ideological differences in India right now that people are still overcoming, versus back 8 years ago when I moved to Hong Kong. It was already clear that crypto was part of everyday conversation over here. There were people that believed in it. There were people that were skeptical of it. But at no point in time was it something that people just were not familiar with. Everyone had an opinion. Everyone had some sort of an idea of what it does. So it's just in terms of the basic knowledge at a regular common man level between India and Hong Kong was a stark difference. I think now it's changing quite intensely, but Hong Kong is a great environment to be able to build and look forward to what innovation can do. Whereas India, I think, as a regulatory environment, is still fairly primitive in terms of how they understand assets. They have high taxation laws which prevent people from wanting to trade with it. And exchanges in India are also heavily guarded from the regulatory perspective, which is both a good thing and a bad thing. It's good because it has oversight, but it's bad because it's prohibitive in terms of how users can bring on board. So it's quite a different environment, but it's like a cheetah and an elephant have a race. One will get there a lot faster, but the other one will be able to carry a lot more weight when it gets there. So that's the elephant taking its course now.
That's a great analogy. So I wonder, like, what are the key lessons that you learn from these two markets for new crypto builders right now? Because right now it's very volatile. We don't know whether this is a bear market or bull market. Is there any lessons that you learned, or maybe you could share to our readers or viewers, maybe our builders in the crypto scene?
Yeah, I mean, I think from personal experience, what I can share is that every time I have had an amazing, fantastic plan, the markets have had other ideas. So essentially, it's along the lines of you can plan as much as you possibly can, but volatility in the space is rampant, as is with any new innovation that comes about. So if we think about it, we're still only in the first 2 decades of this new technology coming about. And as we start to grow and mature, I think it will start to stabilize. But that's not going to happen in the near future. So if you're a builder that's entering the space or has been in the space and you don't have the stomach for uncertainty, this is going to be a very difficult environment to build in. But if you can navigate all of the uncertainty and get to the other side, what you find now, especially in trying times like we have in the market right now, is that the people that still continue to build are the ones that have true conviction. So the filter that you have for the folks that you interact with or other entrepreneurs in the space right now is that you only deal with other people dealing with quality problems and working on quality solutions. So versus the hype that happens in the bull markets of past, compared to what's happening right now, the quality of conversations that I believe I'm having has just been going up, and it makes me mega bullish on this industry, even if today it doesn't might seem like it.
Yes, I mean, it is a really bearish time, not gonna lie. And because I personally, I look at TA every single day, and I'm a strong believer when it comes to the 4-year cycle. So that's why I think it's very much intact. So I kind of want to get your takes on that. Do you think it's intact, or no, it's just like a small correction with bounce back from here?
I think I can only tell you what I believe, right? So
Yeah,
this
yeah,
isn't
go for it.
so in terms of like the 4-year cycles, I buy into it as well, because it's just that in traditional finance you have a decade-long cycle, because without fail, every decade in even traditional finance industries, you have a once in a century event that takes place. So it's just these market corrections continue to happen in a industry like crypto, or even in the blockchain space, or even beyond that. Now it's filtering into other parts of the industry, is that there is so much that happens in such a short period of time. What would take a decade elsewhere takes 4 years. So maybe the 4-year cycle becomes a 4.5 or a 5-year cycle, or that changes. But I think where my fundamental belief is that it's still cyclical. We go up, then we go down, then we wash away all of the people that were here for the hype. Then we build up again, then it brings a new wave of hype. Then something happens, it corrects, and then we go down again. So it's like a waves on the shore. It just keeps coming and going. It's just, if you're willing to stand there long enough, yes, the water will reach you.
Yes, that is definitely a very, very valuable lesson. I personally learned in crypto as well after being in a few years. But you're speaking as a more like a builder in the scene, and what you say definitely carry a lot of weight. Because like one thing very interesting is that okay, you co-founded Metra, and we know what happened. So back in 2025, like just like a very quick context, maybe what's very very quick intro to what actually happened, and we can move on to like how we could bounce back from here for the Metra chain, like what development we have been developing from ever since the crash.
Sure. So before I talk about 2025 April, what I'd like to do is just give a little bit of context. Ohm and Mantra as a token have been around since August of 2020. When we started, we were a DeFi platform, and then we were building other DeFi primitives, all of those including staking, lending, borrowing. And we built up from a Ethereum-based application as we kept working on the problem, which is to bring more and more institutions and people on chain. We realized that one of the things that needed to be done was that we needed a blockchain to be able to do this. So similar to that, we launched Mantra Chain as a full stack layer 1 for tokenization back in October of 2024. At which point in time, the entire Ohm supply from the ERC20 side was already in circulation. So what ended up happening is that there are tokens that were in user hands on exchanges where people could do what they wanted to do in terms of trading activity within the bounds of what exchanges offer. When these bounds were to change overnight, that leads to unforeseen circumstances such as liquidity or unwinding of leverage on some of these platforms. And that is what happened on April 14th, April 13th, 2025. Once that happened, there was a lot of things that came about in terms of how people looked at it, and there's doom and gloom in crypto because without getting the facts, a lot of people just make snap decisions. One of the things was evident that we had a transparency report that was out. We knew where all the tokens were. All of them were tracked really well. One of my lessons at that point in time was that if you're a block explorer that's not exactly like Etherscan, people don't really know how to read what's going on. So that's why we are a Cosmos-based SDK layer 1, which had a slightly different way in which that you would read the block explorer compared to where you would read it on Etherscan. So while it is completely evident on the blockchain that everything was exactly where it is and all of the tokens were exactly where they're supposed to be, a lot of the people on crypto Twitter never bothered to verify that. And since then, we spent a lot of time confirming what needed to happen in terms of like the veracity of the information we were giving. We've been on and on about how this has actually taken place, and that we as a team have been doing nothing other than building from that point forward. So while that crash happened and it was unfortunate, one of the things in crypto is that you can always plan really well, but things happen that are not within your control. Because no matter how much more effort any one of us could have put in, that wouldn't have changed what would have happened at that point in time. Which raises bigger questions in the industry, like do we need circuit breakers? Do we need some kind of checks and measures? Do we want some sort of trading monitoring that takes place? Because when you're a global market in which everyone is responsible for being their own bank, opacity is the enemy of progress. So a lot of the things that happen in opaque environments on platforms that aren't necessarily on-chain, but are providing exposure to on-chain assets. So there is only that much that can happen. And as more and more people start to come on-chain, including the fact that Hyperliquid has since done really well because a lot of that trading activity happens on a blockchain that can be verified as opposed to elsewhere. So you can see that even from the people that want more autonomy, authority, transparency in how they operate, want to build their products on blockchains as opposed to in Web 2 platforms that provide Web 3 access. And to that extent, I think that there's been a lot of progress that we have made in terms of not only the investment that we've received from Invenium afterwards, which is a vote of confidence that we've been doing things the right way. Additionally, we're also regulated in Dubai, which was also a vote of confidence that your regulator said that you're doing everything in the right way. Unfortunate market circumstances do not change the authenticity of the builders that are behind it. So what I would say to the builders out there is that hardships will come and go. Whether you are capable of sticking around and continue to build determines whether you're going to win or going to fall away by the wayside in the space. So since then, we've built our EVM compatibility stack because one of the things is that EVM and Solidity has been chosen as the programming language of the crypto world. Rather than try to recreate the wheel, we are now providing that ability with all of the benefits of being your own layer one. And that has allowed us to provide regulated platform access to products that we're launching on Chain now as well.
Yes, I mean, thanks for sharing that experience. And you are not the only founders I talked to. So as a crypto builder in such a unpredictable environment, a volatile time like this, is there are many uncontrollable factors, and outsiders just simply cannot imagine. And so since Mantra is kind of bouncing back from what happened in 2025, I wonder if the mission, the current, the vision for Mantra has changed after the crash. Is it still RWA tokenization, or there's a pivot as well?
No, I mean, the vision has been very clear, and the vision from when we launched 5.5 years ago to now remains to bring the world of finance on chain. That continues to happen by way of tokenization right now. In fact, my conviction has been solidified even more after everything that we've seen, because it matters that you want to be able to have a system that can be robust enough to support it. So no, we continue to operate on making sure that we're able to bring the world of finance on chain. This is happening both from an institutional perspective, and you can see BlackRock that tokenization is the way forward. At least that's how Larry Fink portrays it. And he seems to be a smart guy, so I'd like to listen to him every once in a while. In addition to that, there's also the retail elements of crypto that happen to be coming on chain, where you have Robinhood that's saying that tokenized stocks and equities are the way forward. You have Revolut that's doing their own version of it. Every single person out there that has been operating in the world of finance is now keen to figure out how do we create the next iteration of what we're doing. Because right now, there is a lot of operational bloat that is required in terms of just pressing the buttons from systems that were created 100 years ago. If we are able to automate all of this logic, especially with the advent of AI, it's just becoming smarter what we can actually do with agents. We're suddenly looking at an era in which that the entire financial system could be run in a completely different way with new plumbing, and built from the ground up would be a lot more efficient for a global access market, as opposed to right now where your access is limited by the physical geography of where you are, despite the information being on an internet server somewhere, which is globally accessible. So these are intermediaries that are being put in place because it's a hangover of the old system. But if we review the system, it's quite likely that we would do away with all of these, because every intermediary is one more commission cut that you have to give in whatever transaction you're doing in the financial world.
Yeah, so you mentioned BlackRock, well, basically all the big guys are entering the crypto market right now. One thing I noticed personally, because I talked to a lot of builders in the field, I talked to TradFi people, I talked to institutions as well. I'm noticing there's a clear, very division between the TradFi mindset and also the crypto native people. So for institutions and TradFi people, they seem to think this is not a bear market. There is just a small correction since DAT is right here. Big guys are here. So there's no way for especially the macro environment right now, all the macro analysts seems to be very bullish. But when I talk to native crypto people, they seem to believe more towards the 4-year cycle. So do you notice the clear division between these two groups here, or you have a different perspective?
I mean, I think in crypto, one thing I've realized is everyone is an expert. So that tends to mean that everyone has an opinion, including me. But I think there is a clear division that exists right now in that if you look at the traditional market, if you see a 10% drop in 24 hours, that's probably like recession max alert everywhere, bells are ringing. In crypto, that's just Tuesday. So I think there's a completely different level of scale that we're thinking about these things. From a macro environment, most people are bullish because we're looking at a macro scale over a long period of time, which is in the decades probably. So from that perspective, what we're seeing right now is general bullish sentiment. It's a few corrections along the way. That's how most people are looking at it. If you see that the plumbing of the financial system is going to change. But if you think of it as, oh, I mean, I was hoping for Bitcoin to hit 150. It's actually now at 60. Then it went up to 70. That scares me because I'm a retail person. These are big numbers. But for most institutions out there, one Bitcoin is a rounding error for them. So I think the scale at which people are impacted, or at least at a personal level, determines how they feel about it. So if you're a retail investor, and when I say retail, I mean anyone that is not an accredited institutional investor. You can be a whale and still be a retail investor. You would be thinking about it from a very personal view in that if it goes down this much, that's the end of the cycle and then lots of bad things happen. But if you think of it from an institutional perspective, the one advantage most career traditional finance professionals have is that they're never actually trading their own money. So you can do it a lot more devoid of the emotion. So the only difference is one is trading and having an opinion with emotion, and the other one is doing it from like their model's perspective. We're both heading toward the same thing. We're both generally aligned. I think the future is just finance. There's no TradFi, there's no NewFi, there's no crypto, there's no DeFi. It's just this new finance that we're entering. Whether that happens in 5 years from now or a decade from now, I don't know. But everyone's opinion right now is that, oh, there's a 5-year cycle, but someone's 2 5-year cycles is 1 decade. So we're all talking about the same thing. It's just different language that we're using.
Yeah, I mean, that's a really good point that you raise. So since you're talking about TradFi and crypto, so the division is getting, the line is getting blurry. We're seeing Coinbase doing tokenization for stocks, while Robinhood is doing the same thing. They're trying to enter the crypto world. So I wonder, as a crypto builder trying to build a project, like how do you, what's the strategy right here in a very volatile time, or maybe during a transition time between TradFi and crypto?
Is the question, how do you build here?
Yeah, so what is the strategy in a period where TradFi and crypto merging together? Is there any strategy that we are changing right here, or maybe towards the projects that you're building?
Okay, I think for me, the way I think about it is if you try to compete with the big boys entering the space, and then you have the bulge bracket banks. So let's not even kid ourselves to say that we have the same capital resources as builders as these banks do. If you try to compete with them on their playing field, it's quite likely that you lose. I'm not saying that everyone does, but it's the rare David versus Goliath equivalent that can win. So for crypto builders right now, or builders in general that seem to be looking at this space, the one thing I would think of as a strategy is, where is your competitive advantage? Because if there's something that agile small teams can do better than any of these large corporations that are well capitalized, is that you have the agility to deliver, iterate, edit, and deliver again. You're on V2, while the first one is still in a committee going through many stages. So the idea is that if you are trying to innovate something new, there's never been a better time, because there's capital entering and a lot of people don't exactly know how to operate with this technology. So tech is your cutting edge. but it's also the problem because sometimes I feel like builders get too caught up in the tech and then they forget that you need users and customers and distribution as well, without which this beautiful genius idea will never see the light of day. So I think the one strategy that I would like to employ for myself is to look at the areas where I have a competitive advantage, look at the segments of audiences that maybe are not looked at consistently by the people that are at the top of the game in terms of their valuations at least, and then look at how it is you're able to solve a real problem. And if we're able to do all of these things and get it into the hands of the people that actually might want to use it, that is a winning strategy. And it wouldn't matter whether you're TradFi or crypto. If you're able to solve for this, it becomes agnostic of the tech stack that you use to make it happen.
All right, so from what you just told me during this interview, you seems to be a strong believer when it comes to tokenization or RWA. But like seeing as TradFi is trying to do the same thing as well, I wonder what is the edge for smaller crypto projects compared to institutions? Because like I think you're building a project called DYSCO as well. Could you like explain what sort of problem that you're trying to solve that maybe TradFi is not here, institutions are not solving right now?
Yeah, I mean, I would love to talk about this because for the last 15 years, when I've been working at the intersection of tech and finance, the idea for DYSCO has been at the back of my mind, and I feel now is the perfect time to do it. So when I was 19, I did an internship in a village in India where they didn't really have access to much in terms of capital to be able to borrow against. So what they did was they pooled all of their resources in terms of the dairy that they had from the 2 cows across 33 villages and 830 farmers, put it together, were able to use that as collateral, get more working capital, and then borrow and build a pasteurization center against it to process it. I know it sounds really small because it's a very, in terms of dollar values, it was less than $30,000 that was spent on this entire thing. But with that, they were able to create processing capability, which was a value add that was able to get them to do more. So DYSCO operates on the same principle in that rather than looking at the institutions that most of the people are looking at right now, DYSCO is looking at the everyman that exists that may have consistent cash flows, may be reliable in terms of what they do for a living, could be gig workers, could be recent graduates, could be anyone that if a bank looked at them, they would probably not deem them eligible to take a loan of any kind. Because when you look at traditional finance institutions, one thing that I guarantee is not going to change anytime soon is that you need to pledge collateral in the form of stocks, bonds, equities, real estate, gold, whatever it is, something physical that if you were to default on your loan, I don't have to trust you anymore or look for you. I liquidate the asset that I'm holding on to. And usually that's able to cover my costs as well. But then what about the entire rest of the population that probably will not have access to this? And with the gig economy going where it is, with Gen Z also having the digital nomad mindset, a lot of these things, if you were to apply for a loan, Gen Z is unlikely to get a loan for their first house, let alone be able to refinance their house and get a mortgage against it. So what do you do in this kind of a situation? So that's where DYSCO is what I believe is a solution that I'm building for it, wherein rather than having physical assets as collateral, your reputation within a community, within a circle, is what is allowing you to access collateral, access loans against that. So the way that it works is it's a mobile first app. You download it. You need to be invited into a circle. So every circle has a 150% cap on it, which means that if you get into a circle and you run away with the money or you default on it because you're able to borrow without any collateral, not only do you have a bad reputation in the ecosystem that is built up, but also the person who proposed that you need to join the circle will also get demerit points. So the idea is that in a world where most people don't have assets and they only have their word to go on, is that word enough incentive to get people to pay back? And in a community where everyone knows everyone else, is that sufficient to get people to repay their loans? So right now I'm in the discovery phase of this. This is also a tokenization of trust, quote unquote, that we're trying to see how this works out. If it does, then it's the marginal utility of a dollar that goes into the pockets of people that are working in this environment versus the marginal utility of a dollar sitting in like a prop firm for a venture capital somewhere that is just that's making money, but not probably being utilized as well. So this is also a form of tokenization at a retail level that we're looking at, and it requires a blockchain design specifically to be able to support this. So that's why this is a completely different way of approaching it. So to your question about what is the strategy for building, this is the way I believe I can build value while we're going forward. And the current market environment doesn't take away for the fact that this continues to remain a problem. And previously, it was due to the lack of dollar value return. It's just expensive for banks to go as far as this kind of last mile connectivity. But crypto has always been infinitely scalable. So whether you're a wallet address that has $1 billion in it, or whether you're a wallet address that has $100 in it, you're still a wallet address in the entire logic of smart contracts. So that is the basis for which DYSCO exists. And it's an experiment for me to see, can we tokenize trust? And is trust enough for people to pay back their loans so that they don't lose face in the communities that they work in?
Yeah, I mean, this could definitely sound like a very interesting idea, and not gonna lie, I think it's my first time hearing a concept of tokenizing trust, because it's very difficult to like tokenize a person or maybe the trust of a person. Like from what you just told me, like there will be 150 people in a certain community, if I got that part correctly. So like, how do I get into the community? Do I just like download an app on the App Store, and I'm part of that one of the 150 people inside that group?
Great question. So the way it's a two-step process. Downloading the app alone is not enough. Where once you download the app, you need to be invited into a circle, meaning that as a user, I can be a part of any number of circles. Every circle will have a cap of 150 people, with the assumption that the social density of 150 people is enough to make sure that everyone at least knows the other person in that community. So once you're invited into it, say you and I are friends at this point in time, I invite you in. Now, because I've invited you into this in this circle where you and I can interact with our money, you can borrow against the trust that we've created over here. We're pooling resources, you're borrowing against it. If you run away with it, then it's also a demerit on me because I invited you into it, and now I lose face because you haven't paid back. Do this enough number of times, and that just debars you from this entire platform. So this is all linked to like a digital ID. That's also a fundamental part of the blockchain that we've built out. It also takes into account the fact that we want to have compliance without surveillance, because these are not trying to get away from any kind of monetary systems. This is more about making sure that is self-policing of these communities sufficient to make sure that there's a thriving borrowing and lending attitude as well as a saving attitude. So that's where the name DYSCO comes from. It's DYSCO, which is an acronym for Dynamic Yield Savings and Credit Organization. So as you come together, more and more people can come together to access yield, access credit, or access their savings products. And all of this is done via an app-based interface, abstracting away all the blockchain behind it. So that's the concept of it. It's still fairly new, like you said. Nobody has been talking about this. This is probably the first time it's being spoken about out loud on a platform such as this. It may work out, it may not work out, but definitely there is a requirement for people to be able to access credit from their circle without needing to go through all of the hassle that people currently go through in that process.
Yeah, I definitely have a lot of follow-up questions to ask about DYSCO. So let's say if you invite me to the group today, like after meeting me for the first time. So, but you still don't know if you could trust me. Yeah, you invited me to the group, and I have the access to basically borrow all this fund inside with like all other unknown people. So if I'm a bad person, doesn't mean I can just like walk away the minute I join the group because like you met me on day one and you seem to trust me.
No, so even though I trust you, there's another 148 people that may not trust you. So what you need to do is build up your behavior over a period of time. So if I invite you in right now, you start off with the bare minimum of lending possible. So if there's a pool of $500 and then you're only allowed to borrow $5. So it means that so essentially where I'm coming at it is from, this is an infinite game, and the Nash equilibrium is that if I keep you in check and if you keep paying back, the size at which I'm able to borrow continues to grow. And that future borrow capability is what I'm working towards. If I try to run away with the system, the protocol is going to have a hole in its pocket for the $5, but now I know for a fact that you may not be a good actor, so you don't have the ability to borrow again. And because it's identity-based, it's basically keeping you in check, whether you're on one platform or whether you go to another circle. Your rep carries through with you.
So, follow-up question. So, today I meet you. So, one of the 150 people inside the group. So, you trust me, but like, how do I meet the other 148 people inside the group? Because like, I'm just like downloading an app on my phone. Like, how do I meet them in person to make them trust me?
So you may not have to meet them in person. We live in an environment in which I have very close friends since my COVID days who I've never met in person, but I trust them deeply. So in the world that we live in, we're also looking at whether knowing someone means whether I know you in person because I've met you physically, or does it mean that I know who you are and I trust you as an individual because we're gamers together, I'm on a Discord server together, or we've been building together. So trust doesn't have to be that you and I have met each other, so that's why I trust you. And trust also could be over here that you don't know anyone else in that community, but then you need to introduce yourself, you need to get someone to vouch for you over there. But the idea is similar to a WhatsApp chat, right? There's upper limit to that WhatsApp chat. But there are 3-person WhatsApp chats, there are 50-person WhatsApp chats. You're supposed to know everybody else over there because those are the people that essentially are going to be your guarantors. So you wouldn't want to be in a circle with people that you don't know because let's flip the script. If they borrow and you're their guarantor and you don't know them, why would you want to be in that situation? So the idea is just because you were invited into it also gives you the option to not join it because you don't know who these other people are. So the idea is that both sides of this equation are incentivized to keep the game honest, because if you're not honest, it also negatively impacts you if someone else plays the bad game over here.
Okay, that is a very interesting idea. I wonder like how we could add that towards maybe like other DeFi platforms like Aave or maybe even TradFi lending.
So I think everyone's been looking at trust and reputation and credit scores and looking at it from different angles. I think Aave in general is probably the best DeFi bank there is right now. And I don't think this is a competitor to Aave as such, because the one point in Aave is that you have hard crypto assets that you can pledge as collateral and then borrow against it. Your reputation over here is pretty much inconsequential because it doesn't matter who you are. If you have an over-collateralized loan and then you default on it, you get liquidated and then the protocol is made whole again. So the idea is probably to take the people that are retail in the sense that they may not have the crypto assets to pledge as collateral and then be able to borrow against it, or they may not have the sophistication, or they may not have the ability to do so. Where DYSCO comes in is that it is looking at the micro retail side of things. So we're starting off with like $100 to $150 loans to begin with. So that means that it is a pilot to verify whether we're able to tokenize trust and to what extent we can do that. Because if we make mistakes in this, if the system doesn't work out at a small scale, we can always rectify it. But all of the other elements depend on our capability of creating a trust-based system. If that is not okay, then we can't do the other steps. So Aave looks at it where Aave doesn't need to trust who I am as a person. Where I'm looking at it is, can we create communities that come on chain and then they borrow, lend, save together? Not enough people talk about money, and that's probably one of the reasons that education about finance is fairly low around the world. If we were to create a common platform where not only do you talk about it, but you help one another out, does that change the dynamic in which how the utility of money moves forward? So a lot of this is still in the discovery phase, and there are a lot more kinks in the armor that are going to come up. But conversations and questions and healthy skepticism is what I'm seeking out right now, and excited to figure out whether this is possible or not.
Yeah, that is definitely a very interesting experiment. I'm personally very interested to see how this get adopted as well. So speaking of Aave, because like you mentioned, Aave is very collateral based. So you have to collateralize your ETH, you have to collateralize some sort of asset. So if the user don't manage to pay off the debt, then your tokens just goes to Aave. So I wonder, how does that work for DYSCO? Like where's the project making money if there is no collateral?
So essentially the way that it works is, if you were to, so the current alternative to DYSCO is that you go to your local circles. There are various forms of rotating savings and credit organizations, other lenders that are in the informal sector. These are I guess whales in their vicinity in the old school way of looking at it, where they give out loans at anywhere between interest rates of 12% and 40%, depending on the requirement. A lot of these are not codified anywhere, which means that a lot of people suffer and they end up paying the interest back, but then they're never able to get the principal down. So the way that this works over here for the protocol and how that would make money is that the circle would determine what the interest rate is that they would want to lend money out at. The idea is that you're lending out to people that are part of the same community and that there is some form of mutual trust that might exist. When you complete an entire loan cycle and pay back the interest, certain amount of that goes towards the protocol. That protocol is the revenue that it generates. With that revenue, part of it goes towards an insurance module, not unlike Aave has over there. So if there is bad debt to it, as the platform continues to scale, as the revenue continues to increase, the insurance module increases as well. And as that increases, the risk parameters start to widen, because to begin with, they will be very narrow to prevent any bad actors from basically draining the protocol and running away with everything. So the idea is that as trust grows in this ecosystem, so too does the capability of greater financial opportunity. So by aligning these two together, the intention is that when Aave is able to liquidate and get their tokens back over there, in certain instances where there are bad actors or there are loss of payment or whatever else happens over there, the person no longer has the ability to access it, which means you have removed that bad actor from the ecosystem. Unlike on Aave, where if I'm a bad actor, I do something over here, I create a new wallet address and go back over there. In this instance, it's linked to your identity. So whether you're coming at it from mobile phone A or laptop B, it still is linked to you. So that prevents that from happening. And the protocol insurance module is there to cover for the financial gaps within it. And again, like one of the fundamental parts is that because you're inviting the person in, it's like if I were to trust this person and I made a mistake in trusting them, then it's a lesson to the entire community over there as well, not to bring in people of that sort. So this reputation travels, and that is the basis where in an environment where you don't have any assets to your name, your word is everything. And if you don't even have your word, then what are you worth?
Yes, that is a very interesting model. I wonder, like, since the whole DYSCO idea is based upon trust, and Aave, there's basically a actual asset that the platform could basically collateralize or collect if the default happens. So DYSCO, does it mean it's gonna the adoption rate gonna be a lot slower because like you need to trust that person at the end of the day, and it takes like a maximum of 149 people to trust you. So does it mean that there's the growth rate going to be a lot slower compared to platforms like Aave?
Actually, I would say that the growth rate is completely different in terms of trajectory from a platform like Aave, because where Aave, I think, targets crypto native audiences, DYSCO is an everyman product. So it doesn't matter whether it is a crypto blockchain, whether it's EVM or whether it's WASM or whether it's any other programming language or Solana behind the scenes. A lot of the things that I have found, at least in terms of user adoption right now, has been this like consistent need to condescend to the users that we have in our industry. So rather, when someone has a user experience issue, rather than say that, okay, we'll fix it, we say that, oh, you don't even know how that works. So that entire attitude is what I think has held crypto industry back by a fair amount in terms of regular adoption. DYSCO as such is catering to the specific need that there are a lot of people that have timing issues, wherein I need some kind of a working capital equivalent for 2 weeks as a gig economy worker, or I'm a recent student that can't make rent. So a lot of this comes down to stuff that happens in the real world already. People do have their community. People do this in the way that they lend out, help each other out. All DYSCO does is create a digital platform that you're able to track it and do it simply, rather than having to do it in an informal way. So I think the trajectory is a lot simpler in terms of adoption, because it's not asking users to learn a new concept and then iterate and operate within that. It's saying that you have an existing concept that you're already doing in the informal lending sector. This is a platform that allows you to track it better and to be able to work with your friends more efficiently. So rather than try to tell you that this is a blockchain product, I think the addressable market for this is much bigger. So maybe in terms of adoption percentages, I can't comment on it. But I imagine, like in terms of sheer number of users, DYSCO has the ability to be far greater in number of downloads than existing crypto platforms, because It will not and does not require you to know the intricacies of how wallets are set up, what seed phrases are, or any of the other things. It abstracts that away. And so for that kind of meld between the crypto world, where we're taking the best of the ledger, which cannot be tampered with, and we have the ability for people to be access it from their App Store, Apple Store equivalent. So that's, in terms of trajectory and the user base, completely different. I imagine there will be an intersection, but essentially anyone that may not have access to a traditional finance loan capability is a potential user of DYSCO from day one onwards.
So another follow-up question that I need to pick a brain on. So since the trust score gonna slowly goes up when more people trust me. So let's say you invited me to the group, I can borrow a maximum of about like $150, like starting with something small, but like eventually when more people trust me, my score gonna go up, and I could borrow a bit more money if I need that money, if I got that part correctly. So if ultimately 149 people trust me as a person, like what is the maximum amount I could borrow then?
So that's the best part, because it's about the community over there, right? So there are going to be some communities that are not going to ever increase the cap beyond $150. But then there are other communities in which that, depending on your contribution, you're able to scale the capacity to borrow against that. So theoretically, you could be 150 VCs that come together. You could be 150 Cha-Chan-Tang employees. You could be 150 rickshaw drivers in India. Or you could just be 20 friends that get together, or it could just be your roommates that are like helping each other out. So the ability, and the 150 comes from the Dunbar number, but it could be anything in between. The ability for you to borrow depends on the community's desire for how much they want to scale that circle. So while as an individual, I can be a part of as many circles as I want, each circle will operate according to different financial logic. Now, the parameters of each circle will be determined by the community that it creates. So it's essentially micro communities determining for themselves what rules they're going to agree to. So if, say, for example, a community you're a part of is of high net worth influencer individuals as well, they want to do it at much larger scale. But beyond a certain threshold, you need to get like consensus from everyone else in over there. But that just means that the people that you're interacting with are of a similar desire to want to be a part of that community. And that desire to want to borrow at greater numbers, or like lend out to other smaller circles, or to be able to probably deploy it into different strategies, it just is a means and platform for you to be able to access and interact with one another. The rules are actually set by the community itself, that the circle decides what the rules are over there. So theoretically, it could be any number that you want, but as long as everyone is in consensus within that particular circle over there.
That's really interesting. I can't wait to actually try that out in person. So if I want to download, is it out already on iOS, or we have to expect some sort of beta or launch?
No, I mean, it's not out just yet. It's currently in building mode. You should expect an alpha version of it to be out for the first few circles coming out in Q1 of this year. Something for users to be able to download should be expected within the next quarter or so. So let's say by June-ish, we should have something a little bit more tangible for you to play around with. Because once it's in your hand, I'm going to find 1,000 more issues. So we're going to get that out as soon as possible.
Yeah, I mean, awesome. Like when it's out, please do let us know. Or if our viewers want to get to know more about the updates of DYSCO, or maybe your personal perspective on the market, where's the best way to reach out to you?
Twitter is the best place. I'm on Telegram as well, but Telegram, sometimes the DMs get lost. So you can follow me at Jayant Ramanand, and I like to read a lot of information. So even if I might not be posting every day, I'm reading everything that's out there. So anyone that has ideas about DYSCO, or thinks that it's a good idea or it's a terrible idea, I like both opinions, please hit me up.
Awesome. So guys, there you have it. So Jayant Ramanand. So thanks for joining us today. We do have more shows lined up here on Roxham TV, so do stay with us. Tomorrow we have another live show